Hi, Charlie. How's your
Hey,
morning
Gurinder.
been so far?
Great to meet you. No, my morning's been great. I'm now currently based in Ottawa. We're all remote, the whole company. So this is kind of a new experience for me as well. How are things on your
Yeah,
end?
definitely. For us, we thought the challenges of the physical organizing of the event
Yeah.
would be more than a virtual event, but it's the same. We have the same kind of challenges organizing with a virtual event. But I appreciate you taking your time and spending your morning with us. I know you have a very busy schedule, and congratulations on all the recent successes in Europe, your UK launch as well. You have done the whole country proud, and I couldn't be more excited to have you here as well. So thanks for joining in, Charlie.
No, it's great to be here. Thanks for having me.
Perfect. So before we jump in, I just wanted to go into your background. How did this Clearbank started, and how did it become a huge company that it is right now? With over $1 billion in investment in e-commerce companies every year. Expansions in Europe and UK. How did this come about, and how did it start? So if you want to just take us through, your journey of how it started, that'd be awesome with the audience as well.
Yeah, sounds good. Maybe I'll give a quick background. At Clearbank, we fund companies anywhere from kind of $10,000 on the smaller end to $10 million in a very data-driven approach. And I think that's kind of our bread and butter. So it's not about who you know or what your pedigree is, but rather we let the transaction data that sits through your marketing, your Facebook accounts, your sales accounts, we let that do the talking. So as a result, like you mentioned, we funded over $1 billion across Canada and US, and now it's starting to kind of launch a bit more globally. And we've also funded kind of 8x more women than traditional VC that we're pretty proud of. So in terms of kind of the early days, I think we've been doing this for 5 years now, but I still think we're pretty early. I think there's a lot more work to be done, and we've only helped a small portion of founders in the grand scheme of things, and we hope that there's a lot more to do. I think on the outside, it probably looks like, thank you for that, there's a lot of people who read the PR can see that we're making big step changes. But I think even from the early days to now, it's on the inside, it's a lot of small iterations. There's a lot of kind of talking to customers, trying to figure out what the pain points are, and making mistakes, quite frankly, and kind of learning along the way. I've done this a few times now, and I think the reality is, whether it's kind of this kind of unprecedented time, or even when the company is smaller, it's often all over the place. At least it has been for my journey, figuring things out, doing things that don't scale, and a lot of that has been kind of my early experiences.
Okay, perfect. And I was listening to your chat on a podcast on McGill University, where you was talking about how the journey started. You had a bunch of friends that were working on this initial idea. Talk us those initial days. Was it very challenging, or did it happen overnight? Because it seems like Clearbank is an overnight success story. That's what it seems from the outside, looking at the PR and all the media attention that you get. But what were those initial days? What kind of challenges you faced? What kind of obstacles you had there going into the startup? And what was the moment that that made you reach out to other guys and make it the company it is right now?
Yeah, no, that's a great question. I think so. We've been building Clearbank for 5 years now, and it sounds like we've had a couple of big announcements in the last couple months, but it's really been years in the making. Our mission, I think, with probably most startups, like the mission rarely changes, or kind of we set out to hopefully build an alternative financing option for entrepreneurs and founders out there, so that they could better scale their business without giving away a large portion of their company. So that kind of vision, or kind of our goals, has never really shifted. But in terms of the product, the way we do it, that's changed quite a lot, kind of month to month even, but definitely years to year. I remember the first couple of years, we were predominantly working with kind of more the gig economy. So for example, Uber, as kind of a platform, Airbnb as a platform, and it's quite different from kind of the businesses that we're working with today. And there's a lot of kind of iterations along the way. And I think one of the things that I've learned throughout this journey is that, when people say product market fit, it's kind of that it's often implied that there's some sort of key or a magical key that once you've got product market fit, it's like it's done, right? Like you've unlocked it and life will be rosy afterwards. I think in reality, what I've experienced at the very least is that product market fit is not a key. It's not a constant. It's constantly changing. Maybe the better analogy is that's either like a dance or kind of like skiing the trails, where once, even if you kind of lock onto the right trail and you're starting to pick up speed, the environment is ever changing. Your customers are changing, right? So the market is ever changing, and as a result, if your product is not keeping up with the market, you lose product market fit after a certain amount of time. So I think to this day, we kind of see ourselves still pretty early on in the journey. There's a lot more building, a lot of experimenting, and constantly kind of iterating. And I think as entrepreneurs, you got to stay resilient and kind of because the market will keep changing. So you got to keep up with the pace, I suppose. Yeah.
Thanks for sharing that. One of the things that happened in the recent past, which has shifted the whole, world is basically the COVID situation. And one thing that came out of the COVID is it has progressed the e-commerce market. I'm not sure if it's right to say, but at least by 5 to 10 years. So the adoption and the utilization of the online platforms for shopping, even from grocery platforms to e-commerce, clothing, everything has changed. How much has that changed your business? What kind of impacts do you see in the industry, and what kind of trends do you see currently in the industry due to the COVID situation specifically?
Yeah, it's been a hard time for the world, right? And I think but I think for the e-commerce side, you're absolutely right. I remember reading a statistic saying that we've kind of compressed kind of 5 years of e-commerce growth in the last 5 months. And I think the stats was showing that we went from, I think, for something like 14%, and that doubled in the first 12 weeks of COVID from a e-commerce to retail ratio perspective.
Okay.
The important part to, like, whenever these kind of big events that happen to me, the part that piques my curiosity the most is the behavioral changes, kind of the shift in how people are behaving. And I think there's a lot of demographics that we're essentially kind of forced to adopt this kind of new environment. And when I think back to actually, I think my parents are a great example. They typically, I've been trying to get them to use Instacart or these kind of delivery services for quite some time now, and it's always the same answer of, no, my apple's going to come back bruised. They don't know how to pick it. This is not good. I'm going to go and shop myself. And I think what COVID did was kind of created almost a forcing mechanism where people had to try it, whether you believed it or not, right? And I think that really allowed people to give it a try and adopt. So I think if we take a step back and think about like traditional businesses, when it comes to distribution, there's really two parts to the equation. There's the education, and then there is the adoption. First, you have to teach the customers why your solution can solve their problem, whatever their problem might be. And then number two is then you have to deliver that product to them, and they hopefully adopt it, right? And I think so case in point is you see this with free trials, right? Like people would try something out for free, and hopefully in 30 days, your habits would have changed enough that you're like, oh, maybe I'll keep paying for Netflix or whatever it is. And why don't I just keep it? And I think what is interesting to think from a business perspective is that COVID effectively almost created like a subsidized free trial for many e-commerce brands and companies out there, right? It's you had to try it, and you had to try it for a prolonged period of time. So if the product was actually good, and we're kind of starting to see for a lot of the interesting companies out there, their product was good, and because it's a prolonged period of time, people are starting to kind of adopt it, and people are starting to kind of it's stuck as a habit. So that's kind of something very interesting to see the behavioral shifts.
Yeah. So we touched base on the behavioral shifts that you mentioned. Do you think it's going to sustain? After this COVID pandemic situation ends, do you think these behavioral changes are going to stay, or maybe decrease or increase based on your experience and the insights that you have? Or is it a one-time thing that people will go back to buying retail, on physically walking in stores and doing that? Or are these changes going to stay? And the reason I'm asking is our theme of this event is resilience and capital. So a lot of these startups that we work with, they want to make sure that if they're investing in the technology, it's good that they're investing in the technology for the moment, but is the technology here to stay, to help them progress in their business growth, basically? So what's your take on that?
Yeah, I think one of the things I actually believe is that, like, whenever there's major technology shifts or events that happens, what tends to happen is, so I guess the question is, what portion is going to what percentage of the shift, or the people who's tried out Instacart or whatever these platform might look like, are here to stay, and which portion will revert back to the mean, right? And I think what ends up happening for a lot of these cases is that majority actually reverts back to the mean. But I think the interesting part is that there is a portion that stays. I think this happened, after the dot-com kind of early 2000s, where SaaS, kind of like subscription, right, became, it wasn't the default, but it became something that was actually acceptable. And there were a portion of companies, Salesforce being kind of the one leading the charge, that really kind of allowed, there were a set of companies that did subscription first, or SaaS first. And then over time, it kind of eats up more and more pieces of the market share. So I would suspect it's probably something similar, where majority probably reverts back to the mean, but then we'll find a much larger portion that were the early adopters that will continue to persist. And if that is the right trend, it will start to eat up more of the market share over time.
Okay. Thanks for sharing that. Now, one thing Clearbank has done really well is, how they have disrupted the space. So you have 20-minute term sheets that you advise really heavily on your websites and on other digital platforms as well. Up to $10 million of no equity, or equity-free funding. How does that become a source for generating leads for your business? And what made you go for a 20-minute term sheets, thinking that there might be challenges or risks in evaluating a startup based on that sheet? And what makes you so confident in your technology that you are able to invest upwards of $1 million in a company, and basically without a cut in the equity as well? So walk us through that process as well.
Yeah. And I think I'll start with the 20-minute term sheet that you mentioned. I think for Clearbank, everything is data driven, and the way it works is that we use AI to assess effectively the financial health and the trajectory of a company, and then we invest anywhere from $10K to kind of $10 million in less than 24 hours. And then the way the model works is that companies kind of pay back on a revenue share basis. So if we invest, let's say, $100,000, we would charge, let's say, a 6% fee. So that's how we make our money. And depending on the size of the company, let's say the company pays back 5% of the revenue until $106,000 is paid back. So that's, and we will make that 6%. So that's how our business model works. And it works particularly well with companies that are using that spend for marketing purposes, or ones that they would get a return on their investment within kind of a few months. And if the economics of the business is sound, we can really help to scale their business without kind of taking a dilution, without the founders taking a dilution. And when it comes to the question in terms of, I guess, how we think about underwriting or how we think about why the data is good is because I actually believe at the rawest forms, the data that we have that we're looking at is the transactional data. It's less the bank, the balance sheet, and kind of the statements that are oftentimes more of a derivative, or it's more of a they also use the transaction data to kind of create the three financial statements, right? So I think what we do is we simply just go to the source, the raw data and the ingredients, and we kind of have built the model from scratch. And I think primarily what we really focus on is, and I think that's kind of where we have a different philosophy when it comes to how we think about the businesses. It's really that founders should be focusing on the core economics of the business. For every dollar that they spend, are they making more than $1, right? Hopefully that is the case. And if that is the case, then they have an economically sound business. And then I think a lot of the other, and if they have an economically sound business, we hope to kind of create an alternative where founders don't need to give up a large portion of their equity in order to scale that.
Mm-hmm. Okay. And I was reading in a report that you had invested $1 billion in 2019 in about 2,000 companies. Is that correct?
Yep, okay. That's right.
And are you on track for the same in 2020 as well?
So we'll be doing more in 2020, and okay. I think our goals for 2020 is much more around kind of a new product per se. So I think like what you mentioned about the 20-minute term sheet, I think the 20-minute term sheet and kind of what we've done a couple of years back is we've made marketing capital. We made it fast and an alternative where it could really help replace, instead of raising equity or instead of taking capital to put into Google and Facebook, there's now an alternative, right? And I think for what we're looking to do next is when it comes to inventory, because when we think about e-commerce, the two biggest spends are either marketing or kind of cost of goods inventory, right? And currently, I think inventory plays a big dilemma in terms of how you manage the cash flows, because you have to buy inventory upfront before you can sell it, but then you don't make money until later, right? Yeah. And I think one of the things that we're doing with our inventory financing product is that we read in the kind of the fulfillment centers and the 3PL data, and by doing that, we could actually de-risk that process entirely. So we want to actually help people fund their inventory, and they don't need to pay anything until they sell the product. So therefore, there's no kind of trying to play balancing of, oh, well, I'm paying X dollars for inventory today, but when will I sell it? But I still need to pay, kind of my interest payments or whatnot. So that's kind of what we're hoping to achieve for 2020.
Okay, thank you. Thanks for sharing that. And what kind of companies do you usually look for when you invest in e-commerce companies? It could be any e-commerce companies, or do you have specific verticals or industries that you target?
Yeah, we're pretty vertical agnostic when it comes to kind of e-commerce companies, and we're actually starting to expand a bit into the subscription, the SaaS space as well. So when it comes to e-commerce, we focus a lot more on the data from a fundamentally, is the business a healthy business? And the way we see this is that really there's kind of like two ways to grow, right? You could either take your profits and kind of acquire customers, right? So that's kind of the bootstrap way. Or you could kind of borrow, raise money, or raise capital in some form. And it'll be more than your profits because so you grow faster. But usually you have to either give up, maybe it's personal guarantees on the debt side, maybe it's equity, a piece of your company or control on the equity side. I think one of the things that that surprised us is that 40% of VC dollars go into Google and Facebook. So the winner is actually the big techs. And what it means is that in order to grow, you got to spend on Google and Facebook. But then in order to spend on Google and Facebook, you need to raise money. So then every time you're growing, you're losing a piece of your business. And I think especially for e-commerce businesses, like you said, customer acquisition is so core to the business that you're kind of faced with this dilemma of do I grow slowly and keep more of my business, or do I grow quickly but then I have to give up more of my business? And we actually believe it's a bit of a false dichotomy of do I have to pick between growing slow and growing fast? And I think for companies, this might be an alternative, which is kind of a different financing option, which is what we're hoping to provide. And it's encouraging that we're seeing kind of more fintechs in the space that's kind of innovating on different verticals and different sectors with kind of alternative financing solutions. Because at the end of the day, we actually have we partner with many VCs on this as well, and we believe that like even the VCs themselves, like there's each VC dollar, ideally you're spending on true risk. It's venture capital. It's true risk capital. Hopefully we're spending on R&D, launching a new product, launching a new country. And we've actually partnered with VCs so that it basically extends for every dollar they're investing into a company, it could be stretched a bit longer, right? Because now that dollar is spent on what it was meant to be spent on, which is R&D and developing new product lines rather than spent on Facebook, right? So.
You touched base on that you have started investing in SaaS companies as well, right? So what kind of analytics or what kind of numbers do you look for in terms of the data driven approach that you have? Because in e-commerce, you could look at the sales numbers, month over month. Is it the subscriptions that you look for, or what kind of data integration platforms do you work with on that side as well?
Yeah, that's right. It's quite similar, I think, at the core. When we look at both on the e-commerce and the SaaS side, there's really two big areas there's many other factors, but I think if I were to boil it down, there are just kind of two big areas that businesses spend most of their time thinking about. One is essentially for SaaS companies, LTV, right? The lifetime value of a customer. Once I get one of these customers, how long do they stay with me, right? Once, like for example, Netflix is a good example. Once I subscribe to Netflix, how many months will I stay subscribed to Netflix? So we pull in a lot of data in regards to the retention in terms of how long each cohort of customers can persist for. And then on the other side, similar to that of e-commerce, is really the acquisition front. How much does it cost to acquire a customer, right? How effective are the advertising? How effective is the marketing to do such?
And what are your plans for the next year? I know you have launched in UK and Europe market as well. What are your future goals for the company? Are there going to be more regional expansion that is going to take place, or are you going to deep down into those specific markets as a business?
Yeah, I think one of the things that we're starting to do is we've been primarily focusing our efforts in North America, Canada and US for the last couple of years now, and the next market we're looking into is Europe. So, and I think Europe is interesting because each country and each market is slightly different. So there's a good amount of kind of localization that needs to be done. So we're starting to think a bit about what does the product look exactly the same for each country, and I guess we're not too sure what the answer is yet. And I think this goes back to that idea of like. On the press, it might look like everything's figured out, but we're still taking customer feedback daily and trying to understand what is the right product, where can we improve, and it's a lot of learnings and boots on the ground.
And one of the things that often comes up is having brand ambassadors for your organization. So you work with Gary Vaynerchuk. He's a big proponent of your business. You also have a Dragon's Den in your ranks. How much does that factor in when you go and ask for when you are raising millions of dollars to invest in these companies? And the reason I'm asking is, if there is another startup that has to come on board which does the same thing as you, how tough would be for them to gain entry into the market, and how much does the brand recognition and the influencer brands that you work with they impact the business and its growth as well?
Yeah, I think the brand has similar to PR. Like the reason someone would choose a company is usually due to trust, right? You believe that that company has the right set of intentions, that they're doing things that are hopefully intended well for your business, whether that be software, whether that be a fintech like ours. And so, but I think when it comes to, let's say, whether it's raising capital or whether it's kind of finding customers, it comes down to the numbers. It comes down to kind of, how good is the product really, and how useful is it for the founders. And when we think about kind of competition or kind of people entering the space, we actually think it's a really good thing, right? Because traditionally, if you wind the clock back 5 years ago or 10 years ago, this kind of a different way to finance is not a question, right? So that choice is actually not a false dichotomy. There was a choice where founders actually had to make, where do I grow slowly and bootstrap, or do I raise money and give up a piece of my company? And I think it's only through kind of, I guess, innovating on these financial options and products that we can actually create a third option, which is, if your business is sound, there's no reason to do either. You could grow quickly and keep your company. So I think we're actually really excited to see that more of the space, whether that's ranging from big players to kind of the smaller startups, are starting to kind of pay more attention to the space and say, oh, there's an opportunity here. Like, Clearbank might be focusing on one vertical or angle, but I think there's other founders there that are underserved. And I think that's what we're trying to do as well. At the end of the day, our goal is to help founders kind of grow their business and help them succeed and hit their goals. And I think a lot of, well, even throughout history, nothing is really accomplished by one company, right? Or one, it's usually the community as a whole, kind of pushing through, being resilient, and kind of moving and shifting the whole industry. So that's how we kind of see the space.
Perfect. What's your take on the diversity and inclusion? I know Clearbank funds 8 times more women entrepreneurs. I think that's what I found out on one of the chats that you had.
Yeah.
So is the data-driven approach, fair compared to the traditional approach that we take? Because all you do at Clearbank is, take the data-driven approach, find out, which companies are, suitable for an investment from Clearbank, and due to that approach, it's established that you have 8 times more women entrepreneurs that have been funded through your model compared to the other traditional models. How do you look at that angle of diversity and bringing more, data-driven approaches which are unbiased and which are fair to the whole ecosystem, basically?
Yeah, I think we're pretty proud of the fact that we fund 8x more women than kind of traditional VCs. It's a nice data point to kind of validate that we're one step in the right direction. But I don't think it's enough, right? I think it's just a start, and there's a lot more work to be done when it comes to, as you mentioned, kind of funding a more diverse group of founders. Because I think if as a sector as a whole, if we fund more diverse founders, whether that be male, female, as well as kind of different, not different ethnicities, and just stopping it there, but in terms of people with different backgrounds, it means that we're actually solving, because at the end of the day, you start a company to solve a problem, right? So if we're funding a more diverse group, it means we're actually tackling a broader spectrum of problems, which is, I think, net a positive for the society. I think the part you mentioned about kind of data and biases, I like that, because we think very similarly. It's very important to be conscious of the biases. We all have them, right? It's to no fault of an individual. The nature of our upbringing, the environment we grew up in, the school we went to, it's kind of human to have biases, but it doesn't make it right? It doesn't make it and doesn't mean that we should just stay with the status quo just because it is. And for data specifically, I think it's very much the same of like garbage in, garbage out, right? If you feed a model with all male founders, for example, then it's likely going to spit out saying that male founders are more likely to be successful, which is not the case, right? So, and I think that is also a very similar kind of biases when it comes to training models, when it comes to smaller cities or regions that typically don't get funding, right? Because they don't get funding, not as many good entrepreneurs come out of it or success stories. So therefore, they keep getting less funding. It's like a vicious cycle. So I think step one is to be very conscious of these biases, call them out, and I think actually the fact that one of the benefits of this kind of unprecedented time is that kind of, I guess, like this conference, right? Like the world is going a bit more remote, and the world is starting to open up where previously kind of whether it be an event or a pitch or an investor listening to someone, you would kind of require that person to do it in the city over coffee or at the boardroom. Now you can do it by Zoom or kind of by one of these just completely remote by dialing in. And I think the more we start to open up to those options, the more we start to listen to those pitches and hear from founders that come from non-traditional cities, the more pleasantly surprised we'll be with the results that, yes, there are good founders that come out of UConn, right? Like just because there's a lower population doesn't mean that there's no good companies. Actually, I have a couple of, I know for a fact there's actually some really good entrepreneurs from UConn. So I think as the world is becoming more kind of globalized, it's if we kind of keep pushing and keep pushing the envelope in terms of having these conversations with people that that perhaps traditionally wouldn't get these conversations, it would then start to kick off the reverse of the cycle, which is you talk to people that are from a smaller demographic or whatever it might look like, and then you get pleasantly surprised that the results are good. It actually leads to better results, and then that reinforces that cycle, right? So I think there's a lot of work to be done as a community, but yeah, that's how we think about from a data and model perspective as well.
And let me take this one step further, and this is a good gossip conversations as well, which is happening with the buzzwords around AI. What do you think, is the future of the data-driven approaches? Is AI going to be, taking over more prominence in making decisions for companies like yours, or what's the future of AI look like to you when you invest in companies? And do you have already, implemented mechanisms in your organizations which are AI-driven and takes the approach, to make those decisions for your organization?
Yeah, so I think there's the way we think about kind of AI and making use of it. It's I think there's two things that we believe in. One is that humans probably have better judgment per se from we want our founders that we fund to be the ultimate deciders of their fate, which is their company. So so a lot of the tools that we're actually building and providing to our portfolio companies are also AI driven. We provide them with kind of recommendations, kind of insights into the business, and the way we think about it is that AI is likely not going to replace humans from a decision-making perspective, but it's more likely going to assist in providing kind of different options, right? It kind of opens up what this could look like. It allows, for example, things that would take a human hours to do on a spreadsheet and scenario plan for an AI to be done within minutes, right? And just say, hey, would you like option A and option B? And allow the human to make the trade-off decisions. I think that's where the human actually really the value of a human's judgment really shines through. It's less about the number crunching, but it's more about making that ultimate trade-off decision of should I pick more A or should I pick more B? I think that this actually holds true in general when I think about decision making as you're kind of growing a business. One of the things that I've really come to learn in the years is that founders should really trust their taste, if you will. What I mean by that is, if you think about it, I'm not a good designer. I'm not sure if you have a design background, but I'm not a good designer. But I kind of know, you kind of tell, right? Like when a design is good or bad. You might not be able to design it. You might not be able to put your finger to it in terms of why it's bad or why you don't like it, or nor can you do a better job yourself. But you kind of know, you kind of have pretty good taste of whether it's good design or bad design. And I think similarly, as founders are building out their companies, what we hope to do is to empower them more to be the people that are making the ultimate, I guess, taste judgment, not to have them build the designs of actually building it out, but choosing, do I like this design better or do I like option B better? And have perhaps more and more of that number crunching, the pixel kind of placing more towards the AI and having tools to help that. So that's kind of how we view decision making and kind of as things go forward.
Thanks for sharing that. I know this is a huge discussion topic right now in the tech circles, with Elon Musk taking one side and the other entrepreneurs taking the other side as well. So I just wanted to get it out there. Going back to the story about how you started and how you grew the organization, one of the key important things with any organization is people. And having a solid core team that allows you to independently take over tasks, run those systems, run the processes. Walk me through that initial phase of hiring and growth, and what were the characteristics that you were looking for when you were hiring those initial people, and what kind of mechanism do you have right now, basically, to hire people? So what's your hiring parameters look like, and if you could just throw some light on that.
Yeah, no, definitely. I think hiring is something that we think a lot about, and it's something that I think is pretty fundamental to a business, right? Because if you think about it, when you look at a business, you take a step back, the financials are really the outputs, right? Like the company makes XYZ products, they sell it, and then after a year, you look at the numbers, you're like, oh, we made this much money, right? That's the financials. The inputs are really the people, right? Who's building the products? Who's making the sale? It's really the people who are the inputs. And the input for the people is the leading indicator, and financials is kind of a lagging indicator. Like if you made all the wrong people decisions, you probably won't see that hit the revenue and the bottom line tomorrow, but you'll probably see it come sooner or later as a lagging indicator. So I think we give a lot of thought in terms of how we're hiring, especially you mentioned kind of early on. I think the smaller the business, the incremental person that comes in represents a larger proportion of the voices in the room, right? And I think those hiring decisions, early days when we were making hiring decisions, it was very much everyone had to meet everyone, so that you rather kind of hire slow, but make sure you bring on the right people than the reverse. And I think from kind of the way we think about hiring now, we've kind of carried on that same ethos where each person that we hire, we hope that that person is better than us, right? I think my personal strengths comes in very much the 0 to 1 or kind of early phase. Whether it's people on our team, our kind of our new CFO, for example, like they are much better operators at whatever they do than I am. And when you actually believe that the people that you've hired are truly better than yourself in whichever domain that they're running, then I think you're probably making the right hire. If you don't think that case is true, then I would, then perhaps, like at least for us, we will question whether that's the right hire or not. So the way we think about it is that each person should be trying to almost, as they're working and building the company, we're almost trying to work ourselves out of a job rather than more into the job, right? So as we're building the company, it starts off being the founders kind of owning, the founder is kind of responsible, wearing many hats and being responsible for each part of the company. As you kind of give one of the hats away to one of the new hires or one of the new members of the team, if you don't, we try to make sure that that person is a lot better than us in that specific domain.
Thanks for sharing that. And this is one question that came through, some of the members that we work with in our audience as well. As they grow and expand, what are the things that they should be looking at, and how much value, each incremental person, as you mentioned, brings on the team as well. I think I'll go back to Tiffany here, our host, and basically see if we have some questions from the audience. But thank you so much for sharing your insights here, Charlie. And I really appreciate you taking your time from a busy schedule to be with us this morning and sharing all the tidbits of the business. And congratulations once again to the huge success Clearbank has. I have a few questions that I see come on from the audience. So maybe I'll just pick one question and I'll go back to Tiffany after that.
Sounds good.
What's the main issue facing the investment landscape right now, in your opinion? So again, I think this relates to the traditional venture capital. So what are the main issues that you see in the traditional venture capital that you're trying to rectify and trying to make amends to? If you want to just mention what Clearbank does differently from the other traditional venture capital.
Yeah, I think we're actually quite complementary to the traditional venture capital. So I think traditional venture capital is, I think if you look back to like venture capital, it was first invented or was first kind of created for really R&D, right? It's back in the day, it was, whether it's back in the early kind of computer chip manufacturing days or kind of developing software in the early days, people raise venture capital and it's kind of equity capital because it's true equity risk, right? Like, I don't know, let's say creating Apple or Microsoft, you don't know whether that software is going to be worth anything or will be useful in any way. So therefore, you're willing to give away a piece of your company and take that high level of risk. But also, the investors also get similar levels of returns. I think over the course of, I think we've kind of stuck with that one vehicle or one mechanism to fund all initiatives, whether from very risky things that we're still doing, which is really good, like self-driving cars, AI, biotech, making new drugs, like those I think need to be continuously invested in. And then also to the spectrum of the less risky things. For example, spending that incremental dollar on Facebook ads, right? Like, is that really that risky? And I think those are the initiatives that we're hoping to not actually, our goal is to actually have venture capital dollars not go there, because for every venture capital dollar that doesn't go on spending Facebook, it means that it should be spent on R&D or something that's truly risk capital worthy. And we think that's better for kind of the founders and society net as a whole. So
I will take up another question and then I promise I will pass on to Tiffany here. What's your advice to the e-commerce startup founders, as they go for raising capital? And this is specifically for the e-commerce and the SaaS startups that you work with. What's your one key advice to them, on when they should be approaching either traditional VC or Clearbank? What are the things that they need to have in place and set up so that they are ready and will be looked with interest by the investors?
Yeah, I think maybe first step is to recognize what are your goals? Like, what kind of company does one want to build? And I think, do you want to actually build a venture scale business, or do you want to build a cash flowing business that could kind of, maybe Tim Ferriss 4-hour work week is a good example. Like, what kind of business are you really going after? And I think that'll dictate whether you want to raise venture capital, whether you want to raise more debt, whether you want to use something like Clearbank. For Clearbank, I would encourage you to sign up, and that way our system will automatically notify you when you qualify. But I think in terms of what to really pay attention to, I would say it goes back to the key metrics and the fundamentals of the business, which is, if a business have great economics, like, that's the fundamentals of the business. What that means is, how much are you paying to acquire a customer? Is it scalable? And how much, once you get that customer, will they pay you, right? And if you have good economics, that kind of means that you could become profitable at any time. It doesn't mean you could become profitable tomorrow, but it means that you have a path towards profitability if you so choose to. And a mentor had always told me this, that the reason you want to have good economics and be profitable and have good margins is that it earns you the freedom to be unprofitable if you want to be. Right? It earns you the freedom to say, because I know my economics are solid, I want to raise venture capital and grow unprofitably for a number of years, or whatever that might look like. But having those solid economics and numbers is what gives you that freedom to do so. So to me, for anyone who's building a business, I would encourage them to pay really close attention to. They're simple questions, but actually not trivial to answer, right? Because you can dig in very deep into in terms of how much the customer is worth from a retention perspective. You could dig very in depth from a Google Analytics perspective in terms of how much does it really cost me to get a customer. But I'd say those are the two fundamental questions. It's how much does it take for you to acquire a customer, and how much is that customer going to pay you?
Awesome. Thank you so much, Charlie, for all your insights and knowledge this morning. I'm sure our audience would appreciate and learn a lot of from this talk here as well.
Pleasure,
thank you so much, and it was a pleasure talking to you. Thank you so much.
Thank you for having me. The pleasure's all mine.
Thanks.